Good afternoon, everyone. My name is Kelly Richardson, and I am the CCIM president for the Washington State chapter. So great to have everybody here today. Today's luncheon is, we have a special treat, and we're going to be talking about the stock market and economic indicators as we're looking ahead. I want to introduce our sponsors. Our Power Partner sponsors are Benaroya, Larry Benaroya and Lisa Goodman, all things office as well as industrial space. Rob Sargent, Sargent Legal. If you have any real estate legal needs, he is a longtime real estate attorney and is your go-to person if you have those needs. Stewart Title, title and escrow. Again, all things escrow and title, please see Kelsey with Stewart Title. And we're lucky enough today to have our sponsor, Kevin O'Keefe with Ameriprise Financial. Kevin is asset management and diversification, and we're going to be hearing more from him as well. I want to thank our annual sponsors, Fred McConkey with McConkey Development, myself, Kelly Richardson with Rowley Properties here in Issaquah, IBA, Kurt Meyer, Mergers and Acquisitions, Dirtfish. If you like to drive rally cars or if you're wanting to learn how to drive in all sorts of weather, please see Dirtfish. They have great classes. They're out in Snoqualmie. Blue Ink Real Estate, Bellingham residential and commercial brokerage. Thank you, Chris. We have Lee with Bank of America and commercial lending. We've got Triple J Properties. Triple J is a real estate syndicate, and they're actively seeking well-located value add or core plus small to medium size medical and dental buildings in the state of Washington. They're also open to investors. We have BII Spaces, and they're an interior design firm utilizing space planning with partnerships with quality office furniture manufacturers. We've got The Shop, and The Shop is a private social club in Seattle and the place where car and motorcycle enthusiasts of all levels can come to build their passion. Their restaurant Derby is open to the public and available after tours in The Shop. We have Larry with Great Earth Realty, specializing in retail investment and leasing. We have our media sponsors, which is the Daily Journal of Commerce, and our in-kind sponsor, Kelly Beckley with BDP Design. We thank her so much for all the work that you do, and thank you for all of our sponsors for being a part of CCIM. You can see more about them on our website, which is CCIM-WA.com for more information. Please save the date for our in-person events. We're going to be having a special luncheon on September 9th, and we're partnering with Crew of Seattle. So this is going to be Wednesday, September 9th. It will be going from probably around, we're thinking 11:30 to 1:30. We've got some fabulous partners that we are working with on this. We're having a representative from Starbucks, and they're going to be talking about their third place concept and their evolution, Starbucks' evolution through COVID and how things have changed. We're also going to be talking about office space and how office tenants have changed, how office buildings have changed, and how office design has changed in COVID. So stay tuned, mark your calendars. More information will be coming up on that, but that will be in person, and it will be most likely at the Washington Athletic Club, but we will be solidifying that here very shortly.
Just chiming in, that's going to be a special day on a Thursday, not our usual Wednesday.
Thank you so much, Amy. So that's a Thursday. So mark your calendars for that. Okay, great. And so as we move forward out of COVID, we are now having live in-person classes. And we're starting off with our 101, which will be on August 30th, going to September 2nd. And we have our negotiations class that we're offering in September, 103 in September as well, and 102 in October. Please see our website for more details. We also have sponsored scholarships available for these live in-person classes. Again, go to our website, CCIM-WA.com. We'd love to have you apply for a scholarship. We've got some housekeeping here. So if you have questions, we'd love to hear them, but please submit them in the Q&A forum, not the chat. You can upvote those questions, and that'll help us prioritize which questions to ask. Now, if you're having technical difficulties, try logging out of Zoom and logging back in. And for any other issues, just contact Zoom support. We are recording this webinar, and it will be available on demand on our website at CCIM-WA.com later this week. Now, I would like to introduce our panelists for today. We are lucky enough to have Kevin O'Keefe with Ameriprise Financial Services. And Kevin began work for Drexel Burnham Lambert Company. He started in the mailroom while attending SPU and worked his way up through the ranks of a financial advisor in 1989. Prior to joining Ameriprise, he advised clients at Morgan Stanley. While he was there, he focused managing accounts, financial planning, asset allocation, and estate planning. He was recruited to Ameriprise because of his experience and success. He is now managing director and private wealth advisor at Ameriprise. He's got 25 years of experience focusing around comprehensive financial planning and money management. He prides himself on placing his clients' needs first and offering exceptional customer service. So thank you so much, Kevin. And we are thrilled to also have Bill Smead with Smead Capital Management. And prior to founding Smead Capital Management in 2007, Bill was the managing director, portfolio manager for Wachovia Securities. Previously, he was with Smith, Barney, and Oppenheimer Company. He began his career in investment business with Drexel Burnham Lambert in 1980. He can be frequently seen on CNBC and other news channels as the stock market expert. All right, welcome, Kevin. I'll let you take it from here.
Thank you, Kelly. We really appreciate you having us today. And I'm really excited to have Bill Smead with us. I've known Bill since the Drexel days, all the way back in the mid 80s. So this is a real treat. Bill is the chairman and chief investment officer at Smead Capital. He manages over $3 billion, including my clients' money and my money as well. Like you said, Kelly, he's a frequent guest on CNBC and Bloomberg, and also has articles in Barron's. And if you stay up late tonight, you can catch him on Squawk Box Europe if you stay up late and watch TV. So anyway, I think I'd like to turn it over to Bill and have Bill give us his thoughts on investing, some ideas in the stock market overall. Thank you.
Thank you, Kevin. Thanks for having us. I look forward to communicating with some people that are much closer to the ground, much closer to Main Street than they are to Wall Street. And I think what I have to say will make a lot of sense to them in a way that sometimes when I talk to people in our industry, they're a little bit too far removed from Main Street. So let me start, first of all, by telling a little story. In 2010, I was on CNBC, and I effectively got put in a position of debating a very famous investor by the name of Jimmy Rogers. And he looked at all of the stimulus that would come from the United States government borrowing the money they had to borrow to get us out of the financial crisis and recapitalize the banks. And he concluded it would be highly inflationary. Well, we took a look, and there was something I did as a child that helped us understand why it was not going to be inflationary. So all of you probably somewhere along the line played the game of Monopoly. And when you play the game of Monopoly, everybody starts with a couple of $1,000. You get $2 for pass, $200 for pass and go, and $500 if you happen to land on free parking. So we played our game until we were blue in the face. And what happened was the cardboard property pieces wore out. We played so much, we literally wore the game out. So we bought a new game. We bought a new Milton Bradley Monopoly game, but we realized that the figurines weren't worn out, and the money in the bank, the original bank, the money wasn't worn out. So what we did was we just doubled the amount of figurines, and we put all the money from the new bank in with the old bank. So quick question for our audience: did doubling the amount of money in the bank cause inflation the next time we played Monopoly? And the answer is no. And the reason is because we didn't give the players any more than $2,000 to start. We didn't pay more for pass and go. We didn't put more than $500 in free parking. So now, that was 09. Now come to today. And what we have done is we have given the players dramatically more money to start the game with, to continue on an ongoing basis. The latest one is, I just read in the paper that my middle son has 4 kids, and he's going to get $300 per kid per month for the next certain number of months, just because they exist. So they're going to give him way more than $200 for pass and go for a few months. So therefore, this leads us right into our presentation, which is, what are the most important dynamics in the common stock market? But then those are also going to be the same dynamics that are going to greatly affect those of you in the property world as well. So if you can bring the slides up. So we're going to talk about value fund in 2021. Go ahead, go to the next slide. So the most important the most important dynamic in the entire economy and in the stock market is that there are currently 90 million millennials. There will ultimately be 95 million millennials, and there was 65 million Gen Xers. So when you've got 36% more humans, and you pay more for pass and go and give them more than $2,000 to start the game, you're going to get explosive economic growth. Explosive. The strongest economic growth since the Reagan years, when it was the baby boomers bumping up against the liquidity created in the 60s and 70s to fight the Vietnam War and do other things. Go ahead and go to the next slide. And what that will do as the millennial group ages, it's creating a massive pivot from a consumer discretionary environment to a necessity environment. So the way I like to think about it is, we're leaving the Seth Rogen movie, craft beer, Chipotle burrito, and Apple device world of the last 10 years with Jeff, who lives at home, living in his parents' basement and laughing about 26-year-old unemployed young men that were drunk and stoned because we wanted to laugh about it instead of cry about it. Now, 10 years later, that's a 36-year-old man. Many of them have jobs. In fact, they can pick just about any job they want right now. I was on a plane yesterday, and a lady that owns a trucking company in Portland was lamenting to me that she can't hire people to drive trucks at $100,000 a year. So this list right here is a list of industries that will be most benefited by the aging of the millennial group. And it is literally a list of necessities: mortgage interest and charges, kids apparel, other apparel, footwear, apparel and services, vehicle finance charge, entertainment, equipment and services, furniture, playground equipment, skip the cell phone service. I'll mention that in a second. Gasoline and motor oil, home furnishings, vehicle purchase, vehicle rental, lease, etc., maintenance and repairs, alcohol, which is going to be a necessity, vehicle insurance, and small appliances. Now look at that list. Those are the industries that are going to be the most benefited by the aging of 90 million people in an economy that has 330 million people and has 240 million adults. By the way, the only thing on this list that's not important is the cell phone. It's going to go up a lot only because they're going to be on their own cell phone bill, and they used to be on their parents. So that's not actually adding any spending. Now, why this is so important is the things on this list have what we call a multiplier effect in good old economics, right? Somebody buys a piece of property and borrows a lot of money. That money goes into circulation and a lot of people get benefited by it. Go to the next slide. So this is just one picture. If you watch TV, if you watch CNBC, for example, there's a wonderful lady, Diane Olick, and she reports on housing. But what she never does is frames where we are in relation to history. This chart frames housing starts as a percentage of population. So if you look at the chart, in the 1970s and 80s, we had 79 million baby boomers looking for houses, and the group in front of them was only 44 million people. So we had to build a lot of houses in the 70s and 80s. And look at the chart. We did. And the financial crisis, which was spawned by the ridiculous residential real estate bubble of 04 through 06, caused a depression in home building. I mean, the worst depression since the 1930s. In 2010, I think it was, we built 310,000 single family homes. The low water mark for single family homes in the deepest recessions of the last 60 years before that was 550,000 homes built. Now, what's bizarre about that is we have 330 million people. So I looked the other day just to get a feel for where we are. In 1985, total housing starts were 1.5 million, about where we are now. But we had 226 million people in the United States. And we now have 330 million. So the point is, housing is going to be the most important dynamic in the US economy. And it is historically an inflationary force, because not only have we given people more money to start the game, but we've got 90 million people that waited 5 to 7 years longer to get out of adolescence and join reality and buy houses. And it's only been kicked into gear for about a year. Go to the next slide. So all the time, everybody says, oh, Bill, but what if the mortgage rates go up? Well, the biggest boom year for building houses in the 70s, or second biggest boom in the 70s, was 1978. And we built those houses at an average mortgage rate of 10.4%. Now, if people would just think straight, why are the millennials, all 90 million of them, the most blessed people that have ever walked the face of the earth, that get to buy their first house at 3.25%? And why do people in the media think that it would be a tragedy if they had to pay 4 or 5? Now, I don't know. It baffles me why they are not framing all this like, hey, we're at historically low levels of building, and B, It's the best mortgage rates of our lifetime. Go to the next slide. This is 4 different charts that show, despite how much house prices have gone up, the affordability is incredibly high, whether it be the interest rate, whether it be mortgage payment as a percent of household income. You know, I don't think people understand where we've come from. Think of Seattle. Seattle is loaded with college educated people, Seattle and Bellevue, that make very high incomes. We're between 22 and 32, single, renting. So they were spending 35% of their income on rent. They were spending 20% of their income on taxes, maybe 25, and 35% of it was discretionary. Now, how many of you were related to or are friends with somebody between the ages of 23 to 30 that were doing some of the most exotic travel you've ever seen? Very expensive travel. They treated it like a birthright. So now what they're going to do is they're going to buy kids' shoes, and they're not going to travel the same way they did, although the more affluent ones are trying to keep it up right now. By the way, just a side note, this group of people are going to be the most bored people at age 55 in the history of the United States, because all the things they should have left for when their kids were grown to do are already going to have been done. Go to the next slide. Households, as measured by the Federal Reserve Board, are in the best financial shape of my lifetime. The household debt service ratio is the most favorable. The savings rate is the highest. Of course, there's a lot of savings. When they're giving you twice as much money to start the game of Monopoly, more money for pass and go, and more money for landing on free parking, who wouldn't save a lot more? Go ahead. So here's just one example of what's going on. In 1994, D.R. Horton, the nation's largest home builder, had 1% market share. Today they have 9%. And that number is going to go way up. In our fund, we own D.R. Horton, Lennar, the 2 largest home builders, and NVR, Ryan Homes out of Washington, D.C., who's the 4th largest. So what's happened to this industry? It used to be extremely fragmented. And now it's coalescing around the 10 large publicly traded builders who have more control over the land. We live in Phoenix now. D.R. Horton just bought 172,000 acres of land that is barren to the east of Maricopa County. They're basically going to extend Phoenix the way Chandler and Gilbert and Mesa did to the east and build houses there in the next 10 to 20 years. So that dynamic, that is the most important factor in the economy, because it's also the factor that drives the economy. So let me just compare. When Chipotle burritos, craft beer, exotic travel, and Apple devices dominated the economy the last 10 years, there was almost no multiplier effect. What do I mean by that? I mean, when somebody that lived in Seattle or Portland or Cupertino or San Francisco or Palo Alto or LA or San Diego and worked for a tech company and was single and was in their late 20s and making really good money, and they'd go in to the bar and they'd order their craft beer, the bartender had to live 2 hours away. The Apple devices were assembled outside the United States. So the people that put the product together had no multiplier effect whatsoever. Okay. Fast forward to today. We're building houses, and we're going to build a lot more than we are now in the next 5 to 10 years. A lot more. So what does that do? Well, let's see. That causes architects, roofers, framers, painters, brick masons, carpenters, plumbers, electricians. I could go on and on and on to all drive to the work site in a brand new double cab truck, maybe buy a house themselves, et cetera, et cetera. It's just got the most spectacular multiplier effect in the entire US economy. Let me tell you, the Obama administration got criticized for how anemic the economic recovery was from 09 to 19. But they really weren't to blame. What they didn't have was they didn't have 90 million millennials replacing 65 million Gen Xers. They had 65 million Gen Xers replacing 79 million baby boomers, right? They did not have the demographics that were needed to create the multiplier effect. Go to the next slide. Just another stock world that looks incredibly cheap. Merck is curing cancer with immuno-oncology, which Fred Hutch was core to creating. The stock is the cheapest relative to the rest of the stocks it's been in 20 years. We love that kind of stuff. Go to the next slide. Commodities hit a 215-year low relative to stocks at the peak of the pandemic. Energy is the smallest percentage of the S&P 500 it's been in my lifetime. Now, an easy way to think about this is there are 8 ways to make electricity, and 3 of them we're not going to do anymore. Nuclear, we're not building any more rivers. And I grew up on the Columbia River. They want to take the dams out at the Dalles and Bonneville and to restore the salmon runs. And coal is non gratis, right? They're shutting down all the coal-fired plants. So what's left for making electricity? Well, there's solar, wind, steam, natural gas, and combustion. So Warren Buffett, when he's at his annual meeting in May, he said, the people that think that we're going to make a really fast transition away from oil and gas, or the people that think we're never going to transition, are both crazy. So there is a lot of money to be made producing oil and gas, whether it goes into cars as gasoline or whether it goes into making electricity to charge batteries. Now, a humorous thought, and again, we're very apolitical in running this fund. I have a humorous thing that I think about. I can visualize Joe Biden doing a fireside chat with everybody in a couple of years, wearing a cardigan sweater, asking everyone to turn their thermostats down so the people in California can charge their cars. So with that, let me stop, go back to Kevin, open it up for questions, and have all of you call my psychiatrist to see if they can do a better job.
Fantastic, Bill. That's great. I loved how you explained the inflation and how that works. You know, everyone's talking about the stock market being too high, and it is now a good time to invest. It's like, I don't want to put any money to work. I always say, if you have a long enough time horizon and you have patience, it's always a good time to invest. How do you feel about where we are in the market cycle and the market valuations, Bill?
That is a terrific question, Kevin. By the way, Warren Buffett answered that question in his annual meeting also. He showed the 20 largest cap companies in the world in 1989, and he showed the 20 largest now. 11 of the 20 in the world in 1989 were Japanese. Japan was on top of the world at that time. They were clobbering everybody. The American auto companies were trying to adapt to their long-term oriented, what was it, Six Sigma or whatever discipline they were using. And their biggest banks were the biggest cap companies in the world. And they're, Sonys and Toyotas. And so the point is, once you get really, really big, it's hard to make a lot of money once you get really, really big. Okay. So you all are in Seattle. Microsoft and Amazon are huge. I'm not saying they're not going to go up some more, but I am saying that it's mathematically likely that they won't do great over the next 20 years, just surely from how much success they'd have to keep perpetuating their stock price higher. Kind of like when Sam Walton died for Walmart, same thing happened. They were huge. Same thing has happened to IBM and a lot of other people. Okay. So that's the first problem. The first problem is the S&P 500 is heavily invested in those gigantic companies. Okay. So the problem most people have is they're either young and they're speculating on CRAP, or they're older and their investments are closely tied to the investments that have done spectacularly the last 10 years. So that's why we own a lot of things that are closely tied to the strong economy and would benefit from inflation rather than, see, when inflation goes up and interest rates go up, the popular growth stocks get unpopular, because a bird in the hand when inflation is going is worth two in the bush. Right now, two in the bush at 1.35% 10-year treasury rates and 3.25% mortgage rates, those two in the bush look hella good to people right now.
Great answer, Bill. And I was going to also, that ties into my next question. Value, which is buying stocks that don't grow as fast as the popular growth stocks, have been out of favor. In fact, they were the most out of favor at the end of last year. I think it was the biggest division between growth and value. Am I right on that? And then since the end of last year, all of a sudden, value, which is what you're describing and how you invest, has taken off. Do you think this trade has legs, or do you think everyone's just going to keep buying the growth stocks?
Yeah. Quick story for your audience that I think that you'd like is, I was running separate accounts back in 99, 2000 for a lot of people in the Pacific Northwest. Most of my clientele was in the Pacific Northwest. And we had made a ton of money for people in 95, 96, 97, 98. And then when the tech bubble got at its height in 98 through 2000, we just stopped making money. The only thing that anybody wanted to own was, the hot technology stocks. And so I was sitting there on March the 9th of 2000. My accounts were down 10% for the year. The S&P was up 5%. And people were leaving us. We had made them a ton of money in the prior 5 years, but they were watching all their neighbors make money so fast, they just couldn't stand it. Well, when the tech bubble broke, we started doing really well. So value, the biggest stretch of great performance for value versus growth was from March the 10th of 2000 to March the 10th of 2003. And we bludgeoned the market and we bludgeoned growth during that 3 years. But Jeremy Grantham, the famous asset allocator, pointed out this last week that of the four biggest temporary underperformances of value that have happened in the last 30 or 40 years, 4 of the 10 happened, the corrections of value versus growth during that 3-year time frame. So since May, value has been correcting against growth, which fits the exact pattern if you go back and look at those charts in Grantham's piece. And I think I'm going to be writing about that coming up here. So it's fits and starts. Rome is not built in a day, and values dominance over growth will not be built in a day.
Makes sense. So Bill and Kevin, is the lower 10-year bond telling us anything?
I could kiss you. If I was in the room with you, I'd kiss you on the cheek. That, I love that. I got that asked. So I was doing a Yahoo Finance streaming TV thing the other day, and it was a young guy, and you know, these young people that are in media and in the stock market, you know what I mean? They look at me like some kind of dinosaur. And the question was, what is the low treasury rate telling you? Well, what it tells you is that day, that's the rate at which buyers and sellers are meeting. That's what it tells you. And secondly, it tells you that interest rates have been going down for 40 years. And that's the default, right? In other words, a human being is going to look at what happened and say, oh, they're going to stay down because they've gone down. And they didn't play enough Monopoly, and they don't understand that they've given more people more money to start the game, and they're giving them way more for pass and go and more for having kids. That's why jobs are so hard to fill. I mean, when you get paid so much for sitting on your rear at home, you know, who wants to go serve Bill Smead at his favorite restaurant or cook for Bill Smead? Becky and I are getting a little lazier as we get older. We like to go to restaurants, but a lot of our favorite restaurants they just can't find people to work. So the answer is, a banker was praying recently, and he said, God, I got two questions for you. He says, are interest rates ever going to go up? And if so, when? And God parts the heavens and says to him, the answer to your first question is yes. The answer to your second question is not in my lifetime. And that's the way it feels. So it's at the rate it's at now because it seems like it's never going to go up again in our lifetime. And when it does start going up, it will go up in a slow, consistent way. And the frogs will be in the boiling water for quite a while before it gets too hot to stand it.
Thank you very much.
Kelly, are there any questions from the audience?
We do. We have a question from Nicole. What specific energy stocks are you closely monitoring?
I love it. I just so everybody knows, my bride and I invest every 90 days in our own fund. I don't do any cherry picking outside of our fund, right? So I don't look and go, wow, this thing just looks so dirt cheap. I'm going to go buy I'm going to call Kevin and have him buy me a bunch of it. Okay. We don't do that. We own exactly what, if your folks call Kevin and want to go into our fund, we own exactly what you'll own. Okay. But I wrote a piece about 5 months ago, and I said, hey, if we ever were going to cherry pick, there's about 11 of these things that look dirt cheap. So I'll give you one example. We own Continental Resources, which is an independent oil and gas producer in the Bakken, in Oklahoma, et cetera. It's 81% owned by the founder, and he's been buying a ton of stock lately. So I took a look yesterday and said, when oil was at $72 a barrel, like it is today, in 2018, what was Continental Resources stock trading at? And the answer was $65 a share. And today it's trading at $37. So oil price is the same as it was then. What's the difference? The difference is people are trained to think there's not ever going to be inflation in their lifetime. They're trained to believe in the economists that are telling them it's transitory. And I can tell you, when 90 million millennials want the things that 65 million people want, it's too many people with too much money chasing too few goods. And that is the classical definition of inflation.
Mm-hmm.
And you commercial property people, you should just love everything I'm saying, because you should all feel like Scarlett O'Hara in Gone with the Wind. She was really depressed, and her dead dad was whispering in her ear, go back to the land, go back to Tara, the land. It's the only thing that lasts, right? Well, guess what? It's also one of the things that only goes up in value when the price of everything goes up in value. They aren't making more dirt.
You know, Bill, it's interesting. This is so great because the only two people that are talking about getting properly invested now are you and Richard Bernstein. I mean, because it isn't happening yet, but it's going to happen. It would be impossible for it to not happen. And I think I read a piece by Cole or something that the millennials have never lived through a rising interest rate environment or an inflationary environment. So do you think that we're going to see a big reset when this stuff starts to really kick in and people start to wake up and say, this inflation isn't transitory, it's real? And have we not seen that yet?
Yeah, the stock market can get really angry about it.
Right.
Yeah, they could. It could happen in a way that they'll get real angry with it. And we'll have a bear market that will be led by rising rates and contracting price earnings ratios on companies other than the ones that are benefiting from it. So just go back to look at what the 1970s looked like and who did well in the stock market in the 70s. It was energy, oil, it was property. You know, when I came in the business right before Kevin did, stockbrokers would go to luncheons and they'd learn about buying garden style apartments in the Sun Belt. That was the inflation investment, or buying leveraged oil and gas tax shelters, and this was late in the cycle in 81. Can you guys all remember E&I? Was it E&I oil and gas, or the local income producing oil property thing that went completely bust and decimated local investors back in 81? Jeff Broughton was really successful with Costco, but he wasn't very good in the oil business.
Can you explain value versus growth a little bit more?
Yes. Yeah, they're really not separable, like the categories that are created for them. The value premise is, if you buy 100 stocks randomly, two different sets of 100 stocks, you're going to get about the same amount of luck in both set of 100 stocks. So what you pay for your luck is going to affect your return. So what we do, we've modified that through our 8 criteria for common stock selection. We want to buy something extremely meritorious when it gets deep in the doghouse. So Jeff Bezos goes into the grocery business and we load up on Target. By the way, if you want to die laughing, go to YouTube and pull up the video of the husbands doing tailgate parties in the parking lot at Target. It's hysterical. Okay, so we wait until Costco divorces American Express on their branded card, and we buy American Express. Right? We buy oil stocks when everybody decides that we're not going to need them anymore because for carbon reasons. We are contrarians. So a value investor wants to outperform the market by buying meritorious stuff way cheaper than everybody else buys it. John Templeton, the great investor, said, if you wait for the light at the end of the tunnel, you're too late. You're not going to get as good a price. Buy at the point of maximum pessimism.
Mm-hmm. But that's contrary to what people do, right, Bill? Because people want to buy what's working because they feel good, and they don't want to sit on a stock for maybe 3 or 4 or 5 months and be patient, knowing they've bought at the right price. Am I right?
Yeah, when Kevin and I worked together, we used to say, dogs chase cars and people chase stocks. Did you hear me say that?
I did, yes.
Dogs chase cars, people chase stocks.
Wow. So do you think that the Fed won't stick to their projection of raising interest rates in 2022?
Gosh, you just ask great questions. I can kiss the other cheek now. So here's what I love about all of us here in the United States. So there's 7 people in China that are effectively their Federal Reserve Board. And they're all men. So they have that deficit. They're all men. And all of these men that run the economy in China, guess where they were educated? At the best colleges in the United States of America. And most Americans think that because they have total control, that they're going to make all the right decisions. So here, we name people to the Federal Reserve Board. And guess where they're educated? The same colleges that the ones that run the China economy are educated in. And we think that they're going to make all the right decisions. Now, I'm 41 years in the investment business. I can tell you that they have about a 50-50 chance of being right. Right? They're dead wrong half the time. They're dead right half the time. Why do we have so much more confidence in the ones in China than we do the ones here? So the answer is, it is highly likely that they're going to be behind the curve on this inflation because they did not play enough Monopoly when they were kids and buy a new game and double the money and realize it didn't affect the game. See, when we recapitalized the banks, we doubled the amount of money in the bank, but no one borrowed it.
So Bill, is there a sector that's screaming buy right now?
Well, I already mentioned the companies that'll save your life. We love Amgen. You know, unfortunately, they used to be. We lived in a condo in Lower Queen Anne, and their building was like 6 blocks down the road. That's now Expedia, right? And Amgen is an incredibly wonderful company. So we wrote a piece a while back. And by the way, if you go to smeadcap.com and you go to smeadblog.com, any of you that are listening to this or watch it later, you can go in and provide your email address. And my son and I are writing all the time, and you can get this stuff. So Amgen has to come up with new products all the time, right? Because you'll create a new medicine, and then you'll get a patent protection for 15 years, but then that eventually expires. So right now, Amovig is the best-selling medicine for terrible headaches, migraine headaches. If you've got high bad cholesterol that hasn't been helped by a statin, Repatha will be added to your statin, and it's 70% likely, or it reduces bad cholesterol by 70%. Okay, so they just have these wonderful products. Prolia is the #1 osteoporosis drug. So what happened during the pandemic is people didn't go to the doctor. So this last year was kind of a crummy earnings year for Merck, Amgen, and Pfizer. But now everybody's going back to the doctor. In the building we're in Phoenix, there's a cardiology office on the 2nd floor that I get stopped all the time because their waiting room's full constantly because everybody that didn't go to the doctor is going to the doctor. Okay. So why is that important? Well, as soon as somebody with osteoporosis goes back to the doctor and find out they have osteoporosis, they will get prescribed Prolia, which is the #1 treatment for osteoporosis. So those stocks are ridiculously cheap, and they just don't. Everybody's afraid to go into them because they're worried about the government controlling the price. But they make medicine. and they save people's lives, and they're incredible, and they're cheap as all get out. So again, you're buying straw hats in the winter when you buy those companies.
Wow, thank you. Well, it sounds like discipline is really important when you invest. Could either of you explain why and what that means?
Kevin, why don't you grab that?
Okay, well, like Bill was saying, he buys these companies that fit these specific parameters, and he also mentioned back in, the early 2000s or 08, 09, he was losing money because he was sticking to his disciplines of buying these stocks that fit his criteria. And it's just extremely important that you have patience when you invest, and you have the correct time horizon, and you stick to your knitting with the discipline of how you buy things. And so that's what I've witnessed people having the most success with. And sometimes it's not going to work. And that's why you have to stick with it and have the patience and discipline. Like people that go look, maybe people will go look at Amgen and Merck and Pfizer, and they'll look at the chart and it hasn't been doing anything. Well, you need to know that these things are happening and be able to buy and have patience and have that discipline that you're getting a great company with a great balance sheet with insider buying, which are all of the criteria that Smead Capital has. So it's the most important thing in having long-term success, in my opinion. Bill?
Yeah, let me jump on top of Kevin's pile there. Wonderful answer. The average American family, when they retire at, say, 64, whatever the age now is that people are retiring, their largest source of net worth is their home for most of them. And why is that? Well, because it's an investment they stayed with for 25 years. Well, the difference between homes and property are pretty neat because you can leverage them up quite a bit. Now, it's not wise to leverage up stocks in the same way because the volatility is so much higher that you can get kicked out by the use of borrowed money. But the absolute returns are dramatically higher. Home prices have probably gone up 3 or 4% a year over the last 40 years. And common stocks have gone up 9 or 10% a year over the last 40 years. So just sit down with your calculator, start out with $100,000 and compound it that extra 5%. But what percentage of humans sat there the whole time and did it? And that's what Kevin's getting out. And by the way, just a plug for what Kevin does. Paying a shepherd to keep you in that chair is worth every penny. They've done lots of studies on do-it-yourselfers and compared that with what financial advisors do. It's called the Dow Bar study. And you have somebody that's incented to keep you in your chair, and you're going to do a way better job.
Agreed. And I will add that Kevin is one of the nicest people I've met in a long time. And so I feel like he's very trustworthy, and having that knowledge and that specific expertise to help manage your assets, that's golden. With that, we are going to wrap up. I want to thank you both so much for your time and your knowledge today. I think we've all learned a lot. I want to thank our audience for attending and our sponsors. Please visit us on our website, CCIM-WA.com. This webinar will be available on recording later this week. And also join us for our networking and other events as we move forward. It's going to be all on our event calendar. So thank you so much. Thank you, gentlemen, for all the information. I'm looking forward to seeing what happens in this economy and where we go. All right. Have a great day. Take care, everybody.